Graeme, how would you describe the Orbis investment strategy?
So in one word, contrarian. The sad reality of investing in the stock market is if you're going to beat the market, you need to transact with somebody else who's going to underperform the market. Generally, people don't queue up to underperform the market. They don't willingly allow you to beat it. And so they need some motivation. And generally that motivation comes in the form of their emotions. It's when they get scared, fearful, greedy, angry, disappointed, impatient. When other investors allow those emotions to cause them to sell stocks at low prices, that creates opportunities for contrarians like us to buy companies at prices that are lower than they're really worth. And that's what you need to do in order to beat the market.
So does that imply that you're not just a value investor, you're a deep value investor?
Sometimes we're deep value investors. Often it's just something's happened to put other people off. So I'm going to give you a few examples. Toyota had a problem about 10 years ago where the accelerator pedal got stuck on their cars and some of them wouldn't stop, and it was all over the news. Other investors panicked. They thought this was going to damage the brand long term. We knew that car companies can go through these events without it damaging the brand, and so we took advantage of that panic and added to it. We bought Apple just after Steve Jobs passed away, when everyone was worrying that Apple couldn't cope without someone like Steve. We bought Google during the global financial crisis when everyone was worried that advertising spending would turn down. So it's not just asset heavy or very low quality businesses we buy. It's just things that have suffered some event that's caused panic.
As a contrarian, do you prefer to be a lonely investor in the stock and have the herd follow you in later?
Absolutely. I think as a rule, our analysts feel much more comfortable being lonely. They feel nervous if they're in a stock that other people like too, because you start to think, there's nothing left for people to learn that's going to cause them to get excited in the future.
How long are you prepared to wait to be proven right?
So when we buy a company, we typically expect to have to wait 4 to 5 years. So we sort of plan that that's how long it's going to take. Obviously, we'd rather wait 4 or 5 minutes, but 4 or 5 years tends to be not a bad sort of average to use for these sorts of things.
And conversely, what's just about the quickest time frame where you've realised that you are in fact wrong and you've exited?
I can't remember one that's quick. There's a lot that we look at and we think they could be good, and then we do more work and realise they're not good and don't buy at all. So there's quite a lot of those that at the surface look like you're getting excellent value and other investors are panicking, and then you find something about the company that you go, oh, actually, this is terminal. For example, they've treated the minority shareholders really badly, or management have acted in ways that are just not in the interest of shareholders. That's often a killer for a company. So that's the most common. I think, definitely we have mistakes. It is a statistical game on average. I think about 60% of our companies outperform the market. That means 40% do underperform. We tend to put more capital in the ones that outperform than underperform. That's why we've generated alpha. But you do have to accept you're going to have some losers. And it is part of our process to identify losers and have ways of helping our analysts overcome that natural human tendency to deny your mistakes.
Could you give us 1 or 2 examples of some of your top holdings or more recent positions? Sure. and why you really like them?
Yeah. My personal favourite is a company called GXO Logistics. They operate in the outsourced logistics market. That's a market that's been growing and will continue to grow rapidly, driven by the fact that in the old days you could do logistics for the US with about 4 to 5 hubs. Most companies could afford to own 4 or 5 hubs, so they did their own logistics, they owned their own warehouses and their own trucks. But as consumer expectations for faster delivery ratchet ever higher, if you want to do next day delivery, you need about 50 hubs. If you want to do same day delivery, you need about 100 hubs. Most companies can't afford to have 50 to 100 hubs, so they've got to outsource logistics. They've got 3 choices. Amazon, but Amazon's often a competitor to many of the underlying companies. GXO, and at a sort of a distant third, DHL, So it's a nice oligopoly. People are sort of essentially being forced to use them. So that sort of generates their growth. But because they were a spin out, and when they were spun out of their parent company, they didn't raise any capital, so the brokers haven't promoted them, so no one really knows them very well. And they're a bit cyclical. They're thought of as being a bit cyclical, and the market started to worry there might be a recession, so they've sold down. So you get good growth. You only pay about 12 times earnings for them because it's perceived to be cyclical. Actually, it isn't cyclical. If you look at the contracts they have with their underlying customers, they're fairly recession resilient because they have these guaranteed minimums and that kick in when shipping volumes fall. So they're sort of protected on the downside by minimums, and they're protected against inflation because the contracts contain full cost pass through to the underlying customer. So great growth, low PE, inflation resilient, recession resilient. There's not many of those around in the world today, and GXO is one of those. The second one would be a company called Global Payments. They're one of the world's big processors of payments, particularly the heavy in the credit card processing space. They're about 12 times earnings today. That's a big discount. They used to trade at about a 30% premium to the S&P 500. You buy them today on a 30% discount, predominantly because their client base are the more small to mid-sized businesses. Those businesses haven't recovered as quickly post-COVID as the sort of mid and larger sized businesses. So there's been a bit of a lag, but you can look back at previous periods in the past. Small and mid-sized companies do eventually recover from recessionary periods, just as they have done in the past. It's a wonderfully inflation-proof business because at the end of the day, all goods and services have to be put through some payment mechanism. I think their long-term profit growth is around about 20% per annum. So you grow at 20% per annum, pay 12 times for it, and it's inflation-proof, but it is a little bit cyclical. You do take some recession risk with it.
Graeme, thank you very much for your time.
Thanks very much.